I'd like to highlight what we think are key competitive advantages. And these are really kind of cornerstones of the philosophy under which we manage money. So the first thing I'd like to highlight is concentration. All of our equity strategies are concentrated, and the global growth strategy owns anywhere between 25 and 30 of what we think are the best businesses in the world. And we think this is an advantage from a couple of points of view. The obvious angle is if you've concentrated your portfolio in businesses that are growing earnings faster than the market, that in essence over time is what's driving the excess return in our portfolio. From the less intuitive angle, we think concentration is also an advantage in terms of managing risk. And it was already noted that we've actually protected capital pretty well in tough environments and outperformed by a wider margin through those challenging periods than we have even during the good times. But over time, delivering consistent results, which is driven by the underlying earnings growth and the results of the businesses we own. And that really leads me to the next point to highlight is we have a very long-term focused approach. And so our average holding period is about 5 years. It's actually been a touch longer than that in the global growth strategy, but roughly 5-year holding period is the way to think about it. And the important point underneath of that is that we are not trying to create returns through activity. It is not a buy low, sell high, identify the theme du jour, or tactically manage the portfolio to generate returns. Our approach is to study the best companies in the world, identify the best of the best, pay a fair price for those businesses, and then let the underlying earnings growth of the company and therefore the aggregate portfolio ultimately drive the returns that we're seeing in the portfolio. And that's precisely what's happened over more than 30 years. So the flagship US focused growth strategy, incepted in 1989, and it's compounded, as Roger mentioned, right under 15% per annum. And that's been driven by a very, very similar underlying earnings per share growth number. Global growth has incepted about 7 years ago, and it has the exact same story to tell. Mid-teens returns over that horizon, driven by mid-teens underlying earnings per share growth. I'd also like to highlight risk management because I think the way we put it together to manage risk is also an advantage. Part of this comes back to concentration. We are truly investing in our best ideas. So we're not investing in our 50th, 80th, 100th best idea. It's a really concentrated approach of the most superior businesses that we can find at fair values. Also, when you think about the risks that come with global investing, whether that be country, currency, policy, other risks that you must deal with, I would just note that within the global growth portfolio, we have a strong bias towards globally competitive and globally dominant businesses. Those sound like simple words, but there's really profound effects underneath. Not only are these companies delivering unique products or differentiated services that are adding value to their customers, they've been able to scale this across 10, 25, 50, perhaps 150 or 200 countries. And so these are truly global franchises in almost all instances. So that we certainly have the ability to own a more localized or regional champion. But if we're going to take on specific country, currency, policy risks, we believe you should be paid for that. And so that frames out a little bit of some of the ways we think about risk and why I think we have some advantages. And then the final point I just highlight here, outcome orientation. To make it very simple, high level, what are we trying to achieve? We're trying to drive solid double-digit investment returns for our clients while taking less risk over time. And we've been very consistent in delivering on that historically.